Hi everyone, let's begin with the second session. We will start with advanced pricing agreement APA. So first thing is that it is not applicable for a specified domestic transaction. For specified domestic transaction, that is we have seen that where the eligible business are being entered into, right? Transaction between eligible business and other business are there. Those will be known as specified domestic transaction if the value is beyond 20 crore, right? So yeah. So advanced pricing agreement will not be applicable to specified domestic transactions. So what's advanced pricing agreement? What does it mean to arm's length price will be determined or specified the manner in which the arm's length price is to be determined in relation to international transaction to be entered by that person. Either the arm's length price it will be determined or the manner in which the arm's length price has to be computed that will be determined. Income referred to in section 9.1 or specifying the manner in which such income must be determined as reasonably attributable to the operations carried out in the India or on behalf of that person being a non-resident. If both the parties are non-resident, what is the income which is being chargeable in India that will be determined? Okay, then what is the validity of APA? APA will be valid for such period as specified in the agreement, which in no case shall exceed 5 consecutive years. So, in no case it will exceed 5 consecutive years, but it could be for a lesser number of period as stated in the agreement. Binding nature of APA. The APA that is APA. That is APA. Uh, so entered into shall be binding on the person in whose case and in respect of the transaction in relation to which a APA has been entered into, and the PCIT, CIT, and income tax authorities subordinate to him in respect of the said person and the said transaction. The authorities and to the person, both for both the APA will be binding on. Non-binding of APA. APA shall not be binding if there is any change in the law or fact having a bearing on the APA. So if something changes in fact or circumstances there, then APA will not be there. It will not be enforced, will not be binding. Then conditions to declare APA as void ab initio. If in the case the board finds that the APA so entered into has been obtained by the person by way of fraud or misrepresentation of facts, the board is empowered to pass an order declaring such APA as void ab initio with the approval of central government. So before declaring the APA as void ab initio, the board has to obtain the approval of central government stating that the APA has been obtained by the person with the intention of fraud or by misrepresentation of facts. Okay, now we said that APA will be valid for 5 consecutive years forward and it could also be rolled back to the immediately preceding 4 years, right? So that is known as rollback provision. Now we will learn about rollback provision. Who is an applicant for that? Any person who's made application will be known as applicant. Definition of a rollback year. Any previous year falling within a period not exceeding 4 years preceding the first of the 5 consecutive years referred to in section 92 CC4, which means 2020-21 is the first year, okay, of the 5 consecutive years of APA. Then it will be rolled back for 2017, 18, 19, and 20 financial years, okay. Then rollback of the agreement. The said rule provides the following. The agreement may provide for determining the arm's length price or specify the manner. Same like whatever we had for APA, it can either specify the arm's length price directly or the manner in which the arm's length price has to be determined that can be specified. Conditions for applying the rollback provision is so important. The agreement shall contain a rollback provision in respect of an international transaction subject to the following. The international transaction is same as the international transaction to which the agreement applies, to which the APA applies. The same transaction has been carried out for the immediate preceding 4 financial years. Then APA will be applicable. That is, rollback provisions will be applicable. The return of income for the relevant rollback year has been furnished by the applicant before the due date. So before the due date, the return has to be furnished. Before the due date, the return has to be furnished. The report in respect of the international transaction has been furnished. This transfer pricing report is also furnished and approved by chartered accountant. Then the applicability of rollback provision in respect of the international transaction has been requested by the applicant for all the rollback years. So see, I cannot request for only 2017 in our case, okay? I have to request for all the 4 years, all the rollback years, all the rollback years. This is so important point, okay? Like I have to, the international transaction which have been entered into now, that is for the APA, should be same as international transaction which have been entered in the rollback years, okay, and the return for that particular year has to be furnished before the due date, and the transfer pricing report has also to be furnished and approved by chartered accountant before the due date, and then the rollback provision has to be requested by the applicant for all the rollback years in which a said international transaction has been undertaken. The applicant has made an application seeking the rollback in the form 3CEDA. That is the form in which I have to make an application in accordance with sub rule 5. Then, when rollback provision is not applicable, rollback provision shall not be provided in respect of any international uh, transaction for a rollback year if determination of arm's length price of international transaction for said year has been subject matter of an appeal before the appellate tribunal, and the appellate tribunal has passed an order disposing the appeal at any point at any time before signing of the agreement. So, before the current agreement has been signed into, that transfer pricing has been a subject matter, that is a discussion matter of discussion of an appeal in the appellate tribunal. Okay, and the appellate tribunal has already passed an order, okay, disposing such appeal before signing this APA agreement. Then the rollback provision will not be applicable. The application of rollback provision has the effect of reducing the total income. We already said that, like in the first itself we discussed, right? If it is reducing the income or increasing the loss, then transfer pricing provision will not be applicable. So, if transfer pricing provision is not applicable, that is arm's length price provision is not applicable, then how come the rollback provision will be applicable? So, this also will not be applicable. So let me repeat it again. Non-applicability of rollback provision if the determination of absolute price has been a subject matter of appeal in any appellate tribunal, and the appellate tribunal has already passed an order disposing the appeal before the signing of this APA agreement, or the if I apply the arm's length principles, the income is reduced or the loss is increased, which means the arm's length principle will itself not apply. Therefore, the rollback provisions will also may not be applicable. Okay, then manner of determining the arm's length price should be the same for rollback years and the previous year. Where rollback provision specifies the manner in which the arm's length price shall be determined in relation to international transaction undertaken in any rollback year, then such manner shall be same as the manner which has been agreed to be provided for the determination of arm's length price of the same international transaction to be undertaken in any previous year to which the agreement applies, not being a rollback year. So let's be same method over all 4 years. Time limit. The applicant may furnish along with the application for advance pricing agreement APA, the request for rollback provision with the proof of payment of an additional fees of rupees 5 lakh. I have to pay additional 5 lakhs to get this done. Yeah, as a fees. Okay. In form 3CDA. Okay. Now, section 920. CD. Okay. Here, what happens is that, let me for the color so it will be highlighted properly. Return where any person enters into the APA and prior and is not NAD, it is and okay, and it is, and don't think my handwriting is so poor, but it's I'm using the mouse, that's why. Okay, yeah, and prior to such date of return has also already been filed in section 139(9) for the previous year to which such APA has been applied. Then the person shall file a modified return within 3 months, within 3 months at the end of the month in which APA was entered. I have entered into an APA, okay, for some period of time, and before the APA order has been passed, I have already filed the return under section 139 because due date has already been passed. Due date has already occurred, okay? That's why I filed the return. So now what happened is advance price agreement has given me some other method, okay? So now I have to modify the return within 3 months from the end of the month in which APA was entered. For example, the APA was entered in 30th November, okay? Or else 25th November, okay? My due date of okay, sorry. The APA was entered in 25th December. Like order was passed in 25th December. My date of return will be 30th November. So I have filed the return. With whatever method I have already taken, I have filed the return. Okay. Now the APA order was passed on 25th December. So what I have to do is from the end of this December, that is from the end of 30th December, which means till 31st March I have time, within which I have to file a modified return with the revised mechanism or revised arm's length price. Okay, if this in the case of return is filed, there is no assessment is there. But if there is assessment which is pending on the date of modified return, then AO shall compute the complete assessment as per the APA, taking into consideration the modified return, and time of completion of assessment shall be extended by 12 months. 1 year again extension will be there. Okay. So what happens is that now I'm filing now I have filed the return on 30th before 30th November, right? And it has been taken into assessment. Okay. Now on 25th of December, APA orders being passed with different ALP or different manner. Okay. Now I have a time till 31st March to file the modified return. So I'm now filing the modified return. What the AO should do now is he should ignore the original return and consider this modified return as the final one and complete his assessment based on this modified return. And for such completion of assessment, he will be granted an additional time of 12 months. Okay, clear? Now, but the assessment is already completed on the date of modified return. So what should he do now? As AO shall pass an order modifying the total income within 1 year from the end of the financial year in which the modified return was furnished, and the AO shall not reassess the income again. He shall not reassess the income, but he will just pass an order modifying the total income. He will not reassess from the beginning, but just modify the total income to the extent of this agreement. Okay, and he will also be given 1 year additional time from the end of the financial year in which the modified return was filed. In our case, it was 31st before 31st March we have filed, right? So from that year and from you have to file within you have to modify and pass an order within 1 year. Okay, now we have to come to the important concept of primary and secondary adjustment. What does primary adjustment mean? Primary adjustment to a transfer price means the determination of transfer price in accordance with the arm's length principle, resulting in an increase of total income or reduction in the loss, as the case may be. So generally, whatever we do, the difference is known as primary adjustment. The first difference is known as primary adjustment. The first difference is known as primary adjustment. Okay. Second, there's 100 and 150 was there, right? The 150 was the arm's length price. That was known as primary adjustment. Secondary adjustment. Secondary adjustment means an adjustment in the books of accounts to associate and associate enterprise to reflect the actual allocation of profits between the associate and associate enterprise, which are considered in accordance with the transfer price determined as a result of primary adjustment, thereby removing the imbalance between the cash account and the actual profit of the associate. This is known as secondary adjustment. Excess money. What's excess money? Secondary adjustment we will discuss, okay? We'll discuss in detail. Before that, we'll know what's the excess money. Excess money is the difference between the arm's length price and the actual value of the international transactions. In our case, it was 50 rupees. That was known as excess money. Difference between the arm's length price determined and the in the primary adjustment and the price in which the international transaction has already been taken place. That is known as excess money. Where secondary adjustment has to be made in order to align the transfer pricing provisions in line with the OECD principles and international best practices. Section 92 CE provides the SSC that will be carried out a secondary adjustment by the primary adjustment to transfer price has been suo motu by the SSC on the return of income or has been made by the assessing officer or is determined by an advanced pricing agreement or is made in the safe harbor rules or is resulting arising as a result of resolution of an assessment by way of a mutual agreement procedure under any agreement entered into section 90 or 90A for avoidance of double taxation. Such secondary adjustment, however, shall not be carried out if the amount of primary adjustment made in the case of an assessee in any previous year does not exceed rupees 1 crore or the primary adjustment is made in respect of assessment year 2016 or an earlier assessment year. So where a secondary adjustment has to be made and we have to comply with the OECD transfer pricing principles. Okay, that is not a secondary adjustment. We have to adjust the books to reflect the actual allocation. We have to allocate the profits. That's why secondary adjustment place. Okay, picture like the cash account. There's no strong works through account and the actual profit should be in line. So that there should not be any imbalance. Okay, that's why secondary adjustment plays an important role. And this is will be carried out in the cases like where it has been requested by suo motu by the SSC or made by the assessing officer and has been accepted by the SSC. That is, primary adjustment has been made by the assessing officer and has also been accepted by the SSC. Or the primary adjustment is determined by the APA, this advanced pricing agreement, or it is determined according to the safe harbor rules, or which is we will discuss. Okay, and then is arising as a result of a resolution of an assessment by way of mutual agreement procedure as mapped under an agreement entered into section 90 or 90 or for avoidance of double taxation. Double taxation avoidance agreement will be there, right? So as a result of that, some primary adjustment is being made. And adjustment will be reflected in the books of accounts. Okay, no adjustment will be required if the primary adjustment is less than rupees 1 crore or it is carried for an year 2016 or 17 assessment year or any other preceding assessment year. Okay. Now we understood what is an excess money, right? What is excess money? 15 in our case was excess money. That is arm's length price minus the actual transaction price will result in the excess money. So what the principle states that, okay, a repatriation of the excess money has to be made on or before 90 days from the date given in the column 3 in the cases mentioned in the column 2. Okay, this is a case, this is a date, and this is the period. Okay, within 90 days have to get repatriated. If it is not repatriated, then interest will be chargeable on the same. Okay, when primary adjustments are being made suo moto, okay, I am making the suo moto by the SSC, then it is from the due date for filing the return, and it is also from starting from the due date of filing the return. Okay, then 90 days will start from this period, that is due date of filing the return. Then is paid by the transfer pricing officer. Then from the date of said order, it will start. Okay. For the primary adjustment, the transfer pricing order is determined by advance pricing agreement. An advance pricing agreement has been entered into before due date of filing the return. If it is entered before due date of filing the return, then it will start from the due date of filing the return. Or if it has been entered after due date of filing the return, the end of the month in which the APA has been entered into from the end of the month in which from 90 days from the end of the month in which APA has been entered into. If safe harbor rules are being exercised, then the due date of filing the return will be the case. Okay, and primary adjustment is determined by the municipal, that is MAP or DTAA. Then the date of giving effect by the AO under Rule 44H such resolution. Whenever the AO gives the effect, then from that date you have a period of 90 days to repatriate the funds. Generally, it is due date of filing of the return or the due date of said order, or only in two cases it is different. Correct. For if it is in the MAP or DTA, then it is date of giving the effect. 90 days from the date it has been giving the effect by AO, and if it is the APA has been entered after the due date of filing the return, then it is 90 days from the end of the month in which APA has been entered into. Okay. Now, you are saying that interest will be charged on the excess money, right? What is the interest rate? That's what we are asking, right? When the international transaction is denominated in Indian rupee, I am denominating it in Indian rupee, then at 1 year marginal cost of fund of lending SBI as on 1st April the relevant previous year plus 3.25. This is the margin, okay? 3.25. So it will be the interest rate of SBI plus 3.25 on that is first April of the relevant previous year, not assessment year, previous year. When the international transaction is denominated in the foreign currency at 6 months LIBOR as on 30th September plus 3 percentage. Okay. In case to above, the rate of exchange for calculation of the value of foreign currency shall be the telegraphic transfer (TT) rate. TTBR, that is telegraphic transfer buying rate of such currency on the last day of the previous year in which its international transaction was undertaken. So, for the previous year it's 22-23. Then 31st March 2023, what is the rate of telegraphic transfer buying rate? That rate will be used for the purpose of determining the value of the international transaction. Okay. Now I told that if I am not paying I'm not repatriating, I have an option, two options, right? One to show the interest income, this is the interest income. Okay, this is the interest income part, and the rate of interest income we have discussed now. The other option was to pay the tax, right? Now we are going to discuss about it. Option to pay additional income tax if the excess money is not repatriated. In a case where the excess money is not repatriated or part thereof is not repatriated within the prescribed time as mentioned above, 90 days, so he has an option to pay the additional income tax at 20.966 for this total income tax. Okay, this is nothing but 18% tax plus 12% surcharge plus 4% cess on excess money or part thereof as the case may be. When additional income tax so paid by SG, he will not be required to make any such secondary adjustment and compute the interest and rate of payment of such tax. From the date he pays the tax, he need not make any secondary adjustment or he need not put anything. Like secondary adjustment will arise in a case where I'm not going to repatriate, okay? There's going to be some advance or something like that. As an example of a case where secondary adjustment could be made, okay? Then this implies that if any case be required to compute the interest till the rate of payment of additional tax. Till the rate of payment of additional tax, he should be computing the interest. So assume I am paying the additional tax on 30th April. Till 30th April, I have to compute the interest income, and beyond 30th April, I will not compute the interest income. The additional income tax so paid by the shall be treated as a final payment of tax. In respect of excess money or part thereof not repaid, no further credit would be allowed. So I pay the tax like it is like advance tax. Don't think like that. It is not like advance tax. I have paid and it's done and dusted. It is the final payment of tax. I will not be allowed a credit in respect of this. For the no reduction in respect of the amount of such additional income tax has been allowed in any other provisions tax. This is like what we discussed now. Okay. Now with this, primary and secondary adjustment topics are getting over. Now we also in the initial part we discussed that if it is a multinational enterprise, it has to maintain some and furnish some reports like master file, CBC reporting, etc. Right? That's what we are going to discuss now. What is a master file? That is, we'll discuss it. The BAPS report recommends that countries adopt a standardized approach to transfer pricing and documentation. So there should be a standard documentation procedure. That's why this was implemented, which is a three-tier structure. There are three different tiers. One is master file, standardized information relevant to all multinational information. It's like master file, which means like it consists of all the it's like index like which consists of standardized information relevant to all multinational enterprises. Local file, specific reference to material transaction of the local taxpayer, which to be made by each constituent entity. He has to maintain his material transaction. Then country by country report, information relating to the global allocation of MNE's income and taxes paid, indicators of location of the economic activity in the MNE group, multinational enterprise group. Okay. So what are the income and what are the taxes? So for example, I have some entities, enterprise in around 20 countries. Then for each country, I have to show this is my income, this is my tax, this is my income, this is my tax, this is my income, my tax, and what is the location of economic activity? Where how did I determine this is the location of economic activity? I have to show the indicators. Okay. Now, there's a specific concept called as notified jurisdictional area. We'll discuss this before we move on to the interest expense allocation. Okay. Notified jurisdictional area. Section 94A allows the Indian government to notify the non-cooperative countries or islands, that is, those locales that abstain from sharing the information as NGA. Okay. Like there are some countries, country reporting, right? Assume Pakistan does not want to share its information with India. Those information which it gets, it is not with respect to the multinational enterprise, it is not willing to share with India. Then, for this, for example, don't think that's the actual case, but it's an example, just an example. Then such that country will be treated as notified jurisdictional area. All parties will be deemed whenever I enter a transaction with anybody resident in Pakistan, then it will be deemed to be an associated enterprise. All transactions will be deemed to be an international transaction, and all provisions shall apply except the variance provision, which we have be given the benefit, right? If it is up to 3%, you need not consider the ALP, right? That benefit will not be given, okay, except that all provisions will be applicable. Any payment to non will TDS will be at 30%. Okay, whenever I make a payment to NGA, I have to deduct TDS at the rate of 30%. If I receive any funds from that person who is an NGA, I have to tell my government or the assessing officer what is the source of fund to that entity for this transaction. Okay, it's not about my source of fund. Okay, I'm getting it from him. What is his source of fund? I have to tell him. If that explanation is not satisfactory, then the assessing officer shall include that such amount of loan as a receipt or receipt as income of my entity. Okay, assume. For example, I have an entity in India. Okay, ABC Limited. Okay, I am getting or receiving some funds from DEF Limited, which is in Pakistan. Okay. Now I have to inform or give explanation to the assessing officer the source of fund for DEF Limited for this transaction. If whatever explanation I'm providing is not satisfactory, the assessing officer may add receipt of fund as income of ABC Limited while computation of taxes. Okay, it's clear, I guess. Now, TDS rate general is 30%. If some higher rate is there in the specified in the act, 40% is there, something or like that is there, then such higher rate will be applicable. Okay. Now, moving on to one more important concept, which is limitation of interest deduction. Okay. I think beyond this, we don't have any concept which is so will be asked in questions. This is the last one which could be asked in the question. Okay. Beyond this, everything will be theory, which could be asked in MCQ. That's why I want to cover it. So this is the last part where questions will be asked. Okay. Yeah. Limitation of interest deduction. That is, I have a borrowing. I'm a borrower. I've borrowed from my associated enterprise. I've charged the interest expense. What is the limitation? It is discussed in section 94. A summary has been given in the Institute Study Material. I have copy pasted it. Okay. Is the borrower an Indian company or permanent establishment of a foreign company? So I am an Indian company, domestic company, or a foreign company, or a permanent establishment which is in India for a foreign company. If I say no, then this section will not be applicable. Then this section will not be applicable. Okay, if I say yes, it is asking me, am I a bank or an insurance company? Am I a bank or insurance company? If I'm telling this as yes, then still this provision will not be applicable to me. So I should be a company which is Indian company or a P of foreign company, and I should not be a bank or insurance company. It is asking me, is the lender PE in India of a non-resident engaged in the business of banking? It's asking me where it is PE of an PE of that lender is there in India, so engaged in the business of banking. If it is a banking, I could just borrow and ask, right? So that's why it's asking. Okay, if I'm saying yes, still then 694B will not be applicable. So it means that I should be a borrower, and I being a borrower should be an Indian company or a permanent establishment of a foreign company. I should not be a bank or a insurance company, and the lender should not be a PE in India for non-residents engaged in the business of banking. If all these three conditions are satisfied, then I should check. Does the interest paid to the non-resident associated enterprise exceed rupees 1 crore? But the interest paid is exceeding rupees 1 crore. Still, I'm saying it's not. It's not exceeding. Then this section will not be applicable. Okay, I'm saying it's yes. Yes, it's exceeding rupees 1 crore. Then it's saying that excess interest shall not be allowable as deduction. Okay, I ask you, what does the excess interest mean? It is saying that total interest paid or payable in excess of 30% of EBITDA or interest paid or payable to associate enterprise for that previous year, whichever is lower. Okay, total interest paid or payable in excess of 30 percentage of EBITDA or interest paid or payable to associated enterprise for that previous year, whichever is lower. Okay, that will be meaning the excess interest. Okay, I am paying. Okay, total interest may be interpreted as the interest paid or payable to a non-resident associated enterprise as per the intent expressed in 94B and also other explanatory memorandum to the Finance Bill 2017. Okay, so what happens is, let's go on. Just give me a minute, I will show an example. Okay, yeah, okay. In the question, I have NP Limited, an Indian company. Go to the ISM question number 8. NP Limited, an Indian company, has borrowed rupees 80 crores on 1st April 2021 from Miss TL Inc., an Indian company incorporated in London at an interest rate of 10% per annum. The said loan is repayable over a period of 5 years. Further, the loan is guaranteed by Miss ST Inc. incorporated in UK. MS Speed Inc., a non-resident, holds 40% shares of voting power both in NP Limited and ST Inc. Okay. Net profits of NP Limited was 7 crores after debiting the above interest. Depreciation 6 crores and income tax 4 crores. Calculate the amount of interest to be disallowed under the head Profits and Gains of Business of Profession, that is PGP, in computation of NP Limited. Give appropriate reasons. If an Indian company, being a borrower, incurs any expenditure by way of interest in respect of any debt issued by a non-resident Australian enterprise, and such interest exceed rupees 1 crore, then the interest paid or payable by such Indian company in excess of 30% of its earnings before EBITDA, or interest paid or payable to Australian enterprise, whichever is lower, shall not be allowed as a deduction as per section 94B. Further, where debt is issued by a lender which is not associated by but an associated enterprise either provides an explicit or implicit guarantee to such lender or deposits a corresponding and matching the lender, such debt shall be deemed to have been issued by the associated enterprise and limitation of interest deduction will still be applicable. In the present case, since Must Wade Inc. holds 40% of voting power, it's more than 26% in both NP Limited and ST Inc. Both NP Limited and ST Inc. would be deemed to be the associated enterprise. Since the loan of 80 crores taken by NP Limited, an Indian company, from TL Inc. was guaranteed by ST Inc. I'm guaranteeing the loan to the lender. Associated enterprise is guaranteeing a loan to the lender which an Indian company gets, right? Associated enterprise NP Limited, such step shall be deemed to be have been issued by the associated enterprise, and the interest payable to TL Inc. shall be considered for the purpose of limitation of interest deduction under section 94B. I'm just guaranteeing, I'm not directly giving, but still it considers as I'm directly giving the loan. Okay. Now, computation will be like here the net profit was 7 crore. I should add the interest already debited, which is 80 crores and net percent is 8 crore. Add depreciation and income tax. EBITDA will be 25 crores. Interest paid. What is the interest paid by me here? 25 crores. Sorry, 8 crores, right? I'm already paying an interest of 8 crores. Lower of the following will be disallowed. Either lower following will be disallowed. Which of the total interest paid or payable in excess of 30%. Okay. Like what is the total interest paid? 8 crores is paid. Okay. 30% of EBITDA is 7.5 crores. So 50 lakhs is the one amount. Okay. Other is interest paid or payable to a non-resident 8 crores paying. Whichever is lower will be disallowed. Interest to be disallowed is 50 lakhs. I hope it is clear. Whichever is lower of the following, like total interest paid or payable in excess of 30% of EBITDA, or interest paid or payable to a non-resident TE, whichever is lower, to be disallowed. To be disallowed. The rest will be allowed. Okay. Now, the summary. Now, moving on all the theory parts. We'll just go over as soon as possible. Country by country reporting has to be submitted by the parent entity of an international group in its country of residence. This report is to be based on the consolidated financial statement of the group. MNE have to report annually for each tax jurisdiction in which they do business, the amount of revenue, profit before income tax, and the income tax paid and accrued. MNEs have to report the total employment, capital, accumulated earnings, and tangible assets in each jurisdiction. MNE have to identify each entity within the group of business in a particular tax jurisdiction, provide indication of the business activity in which they engage. All these are like it's just self-explanatory, right? Then, elements relating to CPC reporting and related matters. Threshold limit. The reporting provision shall apply in respect of international group for an accounting year if the total consolidated group revenue above the threshold to be prescribed is 6,400 crore. If the group revenue is beyond 6,400 crore, then this principle will be applicable. By total consolidated group revenue as reflected is in foreign currency. The rate of exchange for calculation of value in rupees should be TTBR of the currency as the last accounting date. Correct. Fine. That's what we have already followed, right? Then time such report. The parent entity of an international group or the alternate reporting entity, if it is resident in India, shall be required to furnish the report in respect of the group to the JD for every accounting year within a period of 12 months. Within 12 months from the end of said accounting year, it has to furnish this report. Within 12 months from the end of the accounting year, it has to furnish such report. Okay. Then, details to be furnished by a constituent entity. Every constituent entity resident in India of an international group having a parent entity as not resident in India shall notify JD at least 2 months prior to the due date of furnishing the CBSC report whether it is the alternate reporting entity or the details of parent entity. Okay, and where it is situated. This report should be furnished in form 3C EAC. However, if the parent of the constituent entity is a resident of a country or territory where there has been a systematic failure of the country or territory, and such failure has been intimated to the constituent entity, It will be 6 months from the end of the month in which systematic failure have been intimated. It has to intimate and file such report. Okay. Then certain documents for master file, right? So what are those? Every person being a constituent entity has to keep and maintain the prescribed information and document in respect of the international group. Constituent entity has to keep and maintain such prescribed information and document irrespective of the fact whether or not any international transactions being undertaken by the constituent entity. The rules thereunder prescribe the information and document mandated. Okay. The information also to be furnished with such period as may be prescribed the rules. For the if it is not furnishing, then a penalty of 5 lakhs will be. We already read this, right? Reasonable cause of defense against levy of penalty shall be available to the entity. We already discussed this also. Then moving on to the next one. Maintenance and furnishing of information and documents by certain persons. Persons required to keep and maintain the information and documents. Every person being a constituent entity of an international group, if the consolidated revenue of the international group of which such person is a constituent entity as reflected in the consolidated financial statement exceeds rupees 500 crore. For reporting, it has to be 6,400 crore. CBC reporting. Here it is 500 crore to maintain the documents, okay, and records. The aggregate value of the international transaction during the accounting year exceeds rupees 50 crore. Okay, consolidated revenue should exceed 500 crore and the international transaction should exceed 50 crore. In respect of purchase, sale, transfer or lease of intangible property, then it should exceed 10 crore. Keep and maintain information and document of the international group. The rate of exchange should be TTBR as on the last date of the accounting year. The Form 3CEAA master file, however, shall be furnished by every person being a constituent entity of an international group, whether or not master file should be maintained, whether or not the above conditions are being satisfied. For other records and documents, it is like this principle will apply. Then, information and documents to be kept and maintained. This is self-explanatory. You can read it once. Okay, this is like one-time read. List of all entities, chart depicting the legal status, description of the business, then description of the overall strategy, list of entities or important intangible properties, and description of the important arrangements or agreements, description of transfer pricing policies, description of the important transfers in the interest of the intangible property, description of financing agreements, and if any central financing functions is there, or description of the transfer pricing policies being entered into, or a copy of the annual consolidated financial statement, description of the existing unilateral advance pricing agreements, whichever is there. Okay. Now, this report shall be furnished on or before the date of furnishing return of income. This 3CEAA, which is nothing but the master file, right? This master file has to be furnished before due date of return of okay, on or before due date of return of income. Furnishing of report in case of more than one constituent entity. More than one constituent entity is there. Then can be furnished by anyone. One can furnish, okay, if the national group has designated such constituent entity for this purpose, and in this behalf, at least 30 days, it should be information should be conveyed to the JD. Okay, what? For example, okay, um, like I have more than one constituent entity in India. Okay, so the international group has designated one particular constituent entity for this purpose. Okay, you have to sum up this master file, and this information has to be conveyed to JD, okay, at least 30 days before the due date for furnishing the form 3CAEAA. 3CA due date is nothing but due date for furnishing the return of income. So at least 30 days before the furnishing of return of income, I have to intimate the JD that I have been assigned or designated for this purpose of submission of master file. Period for which such information and documents are to be made. It is all 8 years. Okay. Now, important concepts is not discussed by many and they just ignore, right? But we will also discuss this so that if some question is being asked, we will be able to answer it. Okay. Safe harbor rules notified for specified domestic transaction. Section 92 CB provides that determination of income referred to in section 9(1), subsection 1, clause I, or arms price under section 92C or 92C is subject to safe harbor rules. Empowers the CBD to prescribe the safe harbor rules. Okay, safe harbor means circumstances in which income tax authority shall accept the transfer price or income deemed to accrue or arise as may be declared by the SSC. Okay, whichever price is being declared by the SSC, such price can be accepted by the income tax authorities. Okay, this is known as safe harbor. Let's see who are the eligible assessee. A person who has exercised a valid option for application of safe harbor rules in accordance with the provisions of Rule 10 THC. We are going to discuss it. Okay. As a government company engaged in the business of generation, supply, transmission, or distribution of electricity, or as a cooperative society engaged in the business of procuring and marketing milk or milk products. So, if it is safe harbor rule, just remember two things. It either should be electricity or it should be milk. Electricity or milk. Electricity or milk. Electricity or milk. Electricity, government company, milk, cooperative society. Eligible specified domestic transaction. A specified domestic transaction undertaken by an eligible SSC which completes the following: supply of electricity, transmission of electricity, wheeling of electricity, purchase of milk or milk products by a cooperative society from its members. Safe harbor. Where an eligible SSC has entered into an eligible specified domestic transaction any previous year relevant to any assessment year, and the option has been exercised by the SSC is treated to be validly exercised under Rule 10 THT, the transfer price declared by the SSC in respect of the transaction for the assessment year shall be accepted by the income tax authority if it is in accordance with Rule 10 TCH2. I mean THC2. Okay. Which means that all the transactional domestic transactions entered into by the eligible SSC, which we already discussed, government company or a corporate society, can be treated as a and be accepted by the income tax authorities if it is determined in accordance with 10 THC2. The following circumstances. Okay. Supply of electricity, or it could be a transmission of electricity or wheeling of electricity. For that, the tariff in respect of supply of electricity, transmission of electricity, or wheeling of electricity, as the case may be determined in accordance with the methodology or for determination of tariff approved by the appropriate commission in accordance with the provisions of Electricity Act. If the method of determination is approved by the appropriate commission in accordance with the provisions of Electricity Act, then such price will be treated as the will be accepted by the income tax authority. Then, purchase of milk or milk products. The price of milk or milk products is determined at the rate which is fixed on the basis of quality of the milk, namely fat content, solid, not fat content of milk, and the sale rate is irrespective of the quantity of milk procured, percentage of shares held by the members, and voting power. Okay, so it is like basically it is based only on the quality of the milk and not based on the quality. There is no quality discount. It is not any discount given to the percentage of shareholders, based on shareholders or the voting powers. Okay, then such prices are routinely declared by the cooperative study in a transparent manner available in a public domain. So such price should be like it is like uncontrolled. See, it is being the fact, right? Okay, it is like uncontrolled base, right? That's a base of the transfer pricing. So it's an uncontrolled price was also computed in a transparent manner and is available in a public domain. Then such price will be accepted by the income tax authority. No comparability adjustment or allowance under second proviso shall be made when the transfer price is declared by the eligible SSC and accepted by the income tax authority. So you should not make any price. The provisions of Section 92D relating to the maintenance or keeping of information and documents for submission of a report from an accountant shall apply, irrespective of the fact whether option is being exercised, option of safe harbor is being exercised or not. I have to submit the transfer pricing report. And then the assessee has to furnish form 3CEFB, complete in all respects to assessing officer before the due date of furnishing the return of income for exercising the option of safe harbor with clear explanation. I have to submit it. Okay, the return of income should be furnished for. Okay, see, I have to submit the form and also the return of income before the due date of return of income. Okay, then verification by the assessing officer before treating the option for safe harbor by the SSC as validly exercised. The assessing officer has to verify whether the SSC is exercising the option as an eligible SSC. Okay, and the transaction is also price also a in a manner which has been specified. Okay, if both the conditions are satisfied, he is an eligible SSC and he has computed the transaction price in the manner specified there, then this will be treated as a valid transaction price and it will be accepted. Furnishing of documents or information required by the assessing officer. The assessing officer may issue a notice to the assessee to furnish such information or documents and he has to furnish such document within a specified time. Circumstances when option exercise can be declared as invalid. When it can be declared as invalid, the assessing officer has to, by order in writing, he has to be order in writing, declare the option exercised by the SSC as invalid and cause a copy of order to be served on the SSC if SSC does not furnish the information. He does not furnish the information, or it finds that the SSC is not an eligible SSC, or it finds that some specified domestic transaction is not an eligible specified domestic transaction. So it could either be only for electricity and milk. So I'm going for something. Okay, like it is showing that it is like purchase of milk or milk products. I'm supplying the milk or milk products. Okay, then I cannot claim the safe harbor rules, right? Then the tariff is not in accordance with the manner. Okay, it's not compared to the manner specified. Okay, in these four cases, it can be treated as invalid. Order by the assessing officer. Assessing officer has passed an order declaring the option exercise is invalid within a period of 3 months from the end of the month in which the form was received by him. Within 3 months, he has to do this. No order can be passed declaring the option as invalid unless ROBHS being given. Reasonable opportunity of being given has to be made. Okay. Then, filing of objections against the order of the assessing officer. If the assessee objects the order of the assessing officer declaring the option as invalid, he may file his objection with the principal commissioner or the principal director or director. That is PCIT or CIT, PDGIT or DGIT. As the case may be, to whom the assessing officer is subordinate, within 15 days in respect of order, within 15 days have to submit an objection if there is any. Okay. On receipt of the objection, the principal commissioner or PDGIT or DGIT, as the case may be, shall, after providing an opportunity of being heard to the assessee, pass an appropriate order within 2 months. Within 2 months from the end of the month in which such objection has been received by him. Okay. He has to pass an order, whether it is valid or not. Okay, the copy of the order has to be served on assessee and also on the assessing officer. Service of order should be there, both the assessee and the assessing officer. If the assessing officer or the principal commissioner or the commissioner of PDGIT or DGIT, as the case maybe, does not pass an order within a specified time, then the option shall be treated as valid. Okay, if authorities does not pass an order within a specified time, then the option of safe harbor can be treated as valid. All the information and records should exist at the latest date by a specified date. Okay, and that is 31st October of assessment year. Such information has to be kept for a period of 8 years from the end of the relevant assessment year. Yes, assessment year. Okay, so with this, we complete all the things with respect to our transfer pricing. I hope this was really useful to you for a quick revision. Yeah, and we have also covered all the concepts, and thank you for listening to it. If you like it, please do share with your friends so that it will also be beneficial to them. Thank you so much.